Hello class, welcome to our YouTube channel. This is Alan Shane at your service. Thank you so much class for choosing Alan Shane's tutorial for you to be able to know more about accounting. Don't forget to like and subscribe to our channel. So in our today's discussion, we will discuss about the revenue and expense recognition principles. So the process of measuring the performance of an entity, so it requires that income and expense transactions be allocated over several accounting periods. Therefore, adjustment process relies on what? The revenue recognition and the expense recognition principles, because those performance of an entity requires certain income and expense transactions that should be allocated over the several accounting periods. So here we have the definition of the revenue. So according to PAS number 18, revenue states that it is recognized when it is what? Probable. So it will be recognized when it is probable that economic benefit will flow to the enterprise, and these economic benefits can be what? Measured reliably. So we have to remember that we will recognize revenue when there is a probable economic benefits, and those economic benefits can be measured reliably. Okay, nagets? So it shall be measured at what? At fair market value. So it should be measured at the fair value. At the fair value of the consideration received or receivable. Okay, it should be measured at fair value of the consideration received or receivable. So in most cases, revenue is earned in the accounting period when the services are rendered or the goods sold are delivered. Okay, so here we have expense recognition principle. When we say expense recognition principle, these are the expenses recognized in the income statement when it is what? Probable that a decrease in future economic benefits related to decrease in an asset or an increase of a liability has arisen, and that the decrease in economic benefits can be what? Can be measured reliably. Okay? So in the expense recognition principle, these expenses are recognized in the income statement, and it should be probable that those decrease in the future economic benefits will be related to the decrease in the asset and an increase of the liability. And those decrease in economic benefits can be measured reliably. This principle direct accountants to identify what? All the expenses incurred during the accounting period, to measure the expenses and as well as to match these expenses against the revenue earned during that same span of time. So to match expenses against revenues, so it means to subtract the expenses from the revenues in order to compute for the profit or the loss. So here, expenses are recognized in the income statement on the basis of direct association between what? Between the cost incurred and the earning of the specific income. So examples of these expenses on the basis of direct association are the sales commission and the cost of goods sold. So if there is no sale, then the entity has no commission expense and cost of goods sold. So we have to note here that if there is no sale, the entity has no commission expense and cost of goods sold. So here, expenses are recognized in the income statement on what? The basis of direct association between the cost incurred and the earning of specific items of income. So the examples of this are sales commissions and cost of goods sold. Why? It's because if there is no sale, so therefore the entity has also no commission expense and cost of goods sold. So when economic benefits are expected to arise over several accounting periods and the association with income can only be broadly or indirectly determined, so expenses are recognized in the income on the basis of what? Systematic and rational allocation procedures. So this is often necessary in recognizing expenses associated with the using up of assets. So here in the systematic and rational allocation procedures, so this often necessary in recognizing expenses or recognizing expenses associated with the using up of assets, such as property and equipment. Then also allocation of prepaid rent and insurance. So these expenses are incurred regardless of the revenues earned during the period. We have also an expense is recognized immediately. So in the income statement, when an expenditure procedures no future benefits. So when there is when the expenditure procedures has no future benefit, so the expense is recognized what? Immediately. So what are the examples? The officer's salaries, most selling costs, and amounts paid to settle lawsuits. So that's it for our discussion about the revenue and expense recognition principles. Hope you learned something in our discussion for today. Don't forget to like and subscribe to our channel. Thank you so much, class, and God bless. Don't forget to share our channel.